What if I told you that the most important paper written about the future of business in 2026 wasn't written by an insurer, big tech company, or financial services institution? It came out of MIT. And it is not about a specific industrial sector at all on the surface. It is about business models, about the architecture of how businesses or companies create and capture value in the age of agentic AI. But when I read it and then layered it against everything we know about how corporations actually operate, I thought this is the strategic map that every CFO, CEO, and Chief Risk Officer needs on their desk right now. Welcome to Scouting for Growth. I'm Sabine VanderLinden. Today, we are going deep on the MIT CISR paper, Business Models in the Era of AI, and we are going to unpack what it means specifically for financial services institutions, insurers, and risk managers. Not in theory, but in practice. So let's go into it. Let me start with a little context, because I think the MIT paper is even more powerful when you understand where it came from. Peter Weil, Ina Sebastian, Stephanie Warner, and Gayan Benedict at the MIT Center for Information System Research, CISR, published this research brief in early 2026, drawing on surveying data from nearly 2,400 companies tracked over more than a decade. This isn't a trend report indeed. This is longitudinal, empirical research about how business models actually evolve. And what they found is fascinating. In 2013, just over a decade ago, they identified 4 digital business models. These include supplier, omnichannel, modular producer, and ecosystem driver. So, supplier, or companies that sell their products through third parties rather than directly to an end customer. Think manufacturers or wholesalers. They have limited direct customer relationships and rely on intermediaries to reach the market. So in commercial insurance, for example, we use brokers. Omnichannel, or companies with both a digital and physical presence, serving customers across multiple touchpoints seamlessly. Retailers and banks are the classic example here. You can walk into a branch or use the app and the experience is connected. Modular producer, or companies that offer plug-and-play products or services that slot into other platforms or ecosystems. Payment service providers, let's say like Stripe, are the textbook case that we all know. Their product works anywhere, integrates with anything, and customers often don't even see the brand behind it. Ecosystem driver, or companies that create a go-to destination within a specific customer domain and connect customers with a range of providers. Think of a housing platform that brings together listings, mortgages, insurance, and conveyancing, or an app store. The ecosystem driver owns the relationship and orchestrates everyone else. The big takeaway from the MIT research: in 2013, only 12% of companies were ecosystem drivers. By 2025, that had slotted up to 58%. Yes, 58%. And here's a kicker. Ecosystem drivers were the only model of the 4 that consistently exceeded industry average revenue growth. So the market already delivered its verdict. Scale your ecosystem or get out, or otherwise you will be competed by someone who does. But now, with agentic AI arriving, AI that doesn't just generate content, but actually takes actions, makes decisions, and coordinates with other AI agents, MIT has updated the framework entirely. And the new version has profound implications. The 4 new business models for the AI era are existing plus. You augment your existing model with AI. A financial services firm using AI to analyze customer data or to personalize recommendations. It is an enhancement per se, right? Valuable, but table stakes. Customer proxy. Here, the firm represents the customer and achieves their outcomes through predefined AI executive processes, but with guardrails. Think AI automatically managing an investment portfolio, for instance, within set parameters. The firm acts on your behalf. Modular creator. Here, the firm assembles reusable modules, including from third parties, into tailored service bundles. No predetermined process. Instead, the AI figures out the best combination of products and partners to serve each customer's unique needs. And finally, orchestrator. The firm here achieves customer outcomes by orchestrating an entire ecosystem of completely complementary products and services, dynamically, continuously, and in real time. Now, here is where it gets exciting for financial service institutions and insurers. Because when I mapped this framework onto what we know about the corporate operating model, something crystallized. Most corporations today, and in particular insurers, are stuck in existing plus at best. And the gap between where they are and where they need to be is not just a technology gap, it is a business model gap. A fundamentally completely different question of how value is created and captured. And that gap is exactly what we are going to close today. Let me bring this to life with a frame I've been developing alongside the work I do with enterprise clients, what I call the frontier insurer matrix. On one axis, you have the degree to which the firm represents the customer, acting as an advocate rather than just a processor. On the other axis, you have whether the firm's execution is structured, predefined processes, legacy cores, or adaptive, fluid, API-first, ecosystem connected. When you overlay that grid with the MIT framework, 4 archetypes emerge. 1. The legacy carrier. This is the existing plus firm. Rigid org charts across functional silos, manual data entry, traditional policies. The biggest risk here, capacity gaps. When a major weather event hits, a hurricane or a wildfire, and claims volume spikes overnight, the legacy carrier simply cannot flex. It hemorrhages margin because it cannot scale fast enough. Every insurer in the world knows this pain. 2. The agile innovator. This is the modular creator, still assisting customers, but powered by what I call intelligence on tap, fluid work charts rather than org charts, API-driven embedded insurance, hyper-personalized modular policies. This firm has broken the first barrier. It is connecting to relevant tech ecosystems and connectors, third-party data sources, and specialist AI agents. But it is still largely reactive. 3rd, the empathetic advisor. This is the customer proxy in insurance, and this is where it gets philosophically interesting. When AI handles standard underwriting and routine claims triage, the human professional is freed to do something AI will never do well. Empathy, moral judgment, high-stakes advocacy, building relationships with customers and partners. The empathetic advisor monetizes trust. Premium clients pay for human accountability when everything falls apart. And then 4, the orchestrator, the frontier insurer. This is where AI swarms, autonomous, coordinated AI teams, connect with third-party ecosystems to deliver holistic risk recovery, not just indemnification. So let me give you a concrete example. Picture this. A smart home detects a burst pipe. In the traditional model, someone eventually files a claim, a loss adjuster is dispatched, and a check is cut. In the frontier insurer model, the AI detects the sensor alert, cross-references the policy, coordinates with an AI valve to shut off the water, deploys a vetted water mitigation startup to the property, books a hotel for the policyholder, and begins processing vendor payments all before the homeowners has finished their morning coffee. The insurer is no longer just paying for loss. It is preventing loss, managing the recovery experience, and capturing value across the entire ecosystem it has orchestrated. That is a fundamentally different business. Now, here is the critical insight from the MIT paper that I want every insurer, financial institution, risk manager to sit with. The firms that move to orchestrator level are not doing so because they decided to adopt AI. They are doing so because they fundamentally reimagined how their operating model and their business model work together. It starts with what I think of as the three-tiered technology stack of the frontier firm. At the base, your core systems, policy administration, billing, claims platforms become headless, API first, data vaults. They stop being user interfaces for humans and start being high throughput pipes for AI agents. Guidewire that create Majesco cloud-native AI intelligent core or legacy mainframes, their roles changes. They become the system of record. Above that, the big tech agentic AI platforms, Microsoft Copilot Studio, Google Vertex AI, AWS Bedrock. These provide the reasoning engine, the LLMs, the multi-agent orchestration, the enterprise security guardrails. This is where the intelligence on tap lives. When a catastrophic event hits and you suddenly need thousands of digital claims agents working in parallel, this is a layer that delivers that elasticity, infinite scale on demand. And then my favorite layer, the tech connector ecosystem. Think insurtech, health tech, fintech, cybertech, all tech you can think about. The specialist startups, scale-ups, and group ventures that build the domain-specific intelligence that big tech simply cannot. A computer vision company that assesses roof damage from drone footage. Unstructured data ingestion tool that reads a 100-page medical record and surfaces the key facts for a workers' compensation claim. An API connector that automates legal subrogation negotiation. The frontier insurer becomes a curator of this marketplace. It identifies the best-in-class specialist agent for every step of the value chain, and it orchestrates them dynamically. That is the venture client model in action, and it is exactly why equity-free first client partnership becomes so important between corporates and startups, because then they are going to be one of the defining competitive strategy of these decades to actually grow beyond just investing in those companies. Segment 3, finance and risk management. Now, let's pull back and look at the wider financial services and risk management landscape, because the MIT paper's implications, as I mentioned, do not stop at insurance, right? It affects any corporation. For CFOs and finance functions, the shift to agentic AI is already rewriting what the finance operating model looks like. The existing plus model for finance might be AI analysis transaction data, flags anomalies, and generates management accounts drafts. Useful, incrementally valuable, but entirely bounded by predefined rules. The customer proxy model for financial services firms Think autonomous portfolio management, AI acting as a steward of your financial goals, continuously optimizing asset allocation, rebalancing in response to market signals, and executing within guardrails. You are set, right? No robo-advisory as we knew it in 2015, something far more sophisticated, continuously learning and genuinely acting on your behalf. The modular creator in finance assembles bespoke financial products dynamically. Imagine a corporate treasury function that when a client needs a complex structured product, draws on modules from credit, FX risk, insurance, and regulatory compliance, assembling a tailored solution in hours, not weeks, through AI-coordinated specialist agents. And the orchestrator in financial services, well, we are beginning to see the earliest versions. Wealth management platforms that don't just manage your investments, but coordinate your entire financial life. Tax optimization, estate planning, insurance coverage, philanthropic giving, mortgage refinancing, all orchestrated around your outcomes, not the firm's product catalog. The risk management implications run even deeper. And I want to be honest about the duality here because agentic AI is at the same time one of the most powerful risk mitigation tools in history and one of the most significant new risk categories that risk managers have ever had to govern in the past. On the opportunity side, the ability to run continuous risk surveillance across an enterprise, correlating signals across portfolio, operational, climate, cyber, and regulatory dimensions in real time is transformative. We are moving from risk management as a periodic review process to risk management as a continuous, adaptive intelligence function. For P&C insurers, for instance, this changes the actuarial function entirely. Instead of pricing risk retrospectively based on historical data, the frontier insurer prices risk dynamically in real time using streaming telemetry, satellite data, climate models, and social signals. The combined ratio that critical measure the underwriting profitability becomes something the AI is continuously optimizing, not just something the CFO reviews quarterly. But here is where risk managers must stay sharp. The MIT paper is very deliberate about the role of guardrails. At every level of the new business model framework, customer proxy, modular creator, orchestrator, the researchers emphasizes that AI operates within guardrails. The firms, humans, set those guardrails, and the quality of your outcome depends entirely on the quality of those guardrails. What does that mean in practice? It means that risk governance in the agentic era is not about supervising AI outputs after the fact. It is about designing the decision frameworks, the ethical boundaries, the escalation protocols, and the overriding mechanisms before the AI is ever deployed. The risk function has to move upstream from auditor to architect. And this connects to something I find genuinely exciting about the human-agent ratio, a concept that sits at the heart of the frontier firm model. Different tasks, different risks, different complexities. They all demand different ratios of human to AI involvement. A routine policy renewal might run at a 1:50 ratio. One human overseeing 50 automated processes. A catastrophic liability claim involving a fatality, you might need 3 senior specialists supported by 1 quantitative research agent. The AI informs, the humans decide, and they carry the accountability. Getting that ratio right by task, by risk level, by regulatory context is one of the most important operational design decisions that financial services leaders will make this decade. So what do you actually do with this? Because I know you, our listeners, you are not theorists, you are operators, you are building things, leading teams, making decisions with real capital and real consequences. So let me give you 5 imperatives. 5 moves that I think every leader in insurance, finance, risk needs to be making right now. First, look at yourself honestly on the matrix. Are you truly existing plus, modular creator? Be rigorous, because the danger of the current moment is that organizations call their AI pilots transformation when they are actually enhancements. The MIT research is very, very clear here. Genuine business model evolution requires reimagining value creation and value capture, not just speeding up existing workflows. Second, make your core systems headless. This is a prerequisite. If your core policy or claims systems cannot be accessed via API by AI agents at machine speed, you cannot build the frontier firms on top of them. This is not optional infrastructure work, actually. This is the enabling layer for everything else. Prioritize API, throughput, and data architecture above new AI features. Third, build your connector ecosystem. You are not going to build every specialist capability in-house, nor should you. The venture client model, becoming a startup's first client rather than their investor, is how the smartest insurers and corporations and financial firms are accessing domain-specific AI capabilities without the risk and cost of full acquisition. Scout, pilot, validate, scale. That is a playbook. Fourth, redesign your governance frameworks around guardrails, not gatekeeping. The risk function cannot be a blocker to AI adoption, but it absolutely must be the architect of the ethical and operational boundaries within which AI operates. Build your AI ethics frameworks. Define your human-agent ratios by workflow. Create your overriding and escalating protocols before you need them. Fifth, invest in agent bosses. The human role in the frontier firm is not shrinking, it is shifting. Your people need to learn how to prompt, direct, quality assured, and orchestrate AI agents. They need to become comfortable managing digital colleagues as fluently as they manage human ones. That is, learning and development challenge. Start now. Think about M-shape, T-shape, S-shape. The business is going to be completely reconfigured. The MIT paper frames this beautifully. Companies need to understand where they can create value. Does your firm merely assist customers, or can it represent their goals through autonomous action? Is your execution built on a structured process, or can it be adapted with the help of AI agents based on each customer's desired outcomes? Those 2 questions should be on the agenda of every executive team and every board in the financial services sector. We are genuinely at a rare moment. The kind of structural shift that comes along perhaps once every 30 years, where the rules of how value is created, captured, and distributed get rewritten from the ground up. The MIT CISR research gives us something invaluable, an empirical grounded map of where business models are heading. No speculation, evidence, and the trajectory is unambiguous. The ecosystem drivers, the orchestrators, are already capturing disproportionate growth. The gap between them and everyone else will only widen as agentic AI matures. For insurers, financial services institutions, for risk managers, for all transformation executives, the opportunity is extraordinary, not because AI is exciting technology, but because it enables something that has already been the ultimate promise of our industry, being genuinely present for people at their most vulnerable moments, at the scale they need, without the capacity constraints that have always been, preventing us to do the work we promise to do for our customers. The frontier insurer doesn't just pay the claim, for instance. It prevents the loss, manages the recovery, and builds the relationship that lasts a lifetime. This is not a technology story. As you can see, this is a purpose story. And that is why I believe the leaders who will define this industry over the next decade are not the ones who are asking, how do we add AI to what we already do? They are the ones asking, what can we now do for our customers that was simply impossible before? That is a question worth building forward. Thank you for spending 20 minutes of your day with me. If today's episode sparked something for you, I'd love to hear from you. Share it, comment on it, challenge it. The conversation is the point. Until next time, keep scouting, keep building, and keep growing.